Mohamed El-Erian is one of the most prominent financial figures in the world. Since the beginning of 2021, he has made dozens of appearances on CNBC and issued predictions that have largely come true, warning that the market is in risk of a crash and that inflation would continue to soar. Hello everyone, and welcome back to our channel. In today's video, we'll talk about El-Erian's prediction about inflation. So stay until the end of the video to learn it all. Mohamed El-Erian, a well-known economist, predicts that although inflation will decline by year's end, it will be sticky. I'm looking for a core CPI in the 4.5 to 5.5% range, so well above the 2% target of the Fed, the Chief Economic Advisor of Allianz said on Influencers with Andy Sewer. The Consumer Price Index, CPI, measurement for the most recent month was 9.1%, which is the highest level since November 1981. On Wednesday, the July CPI number will be made public. The collateral harm that will result from inflation decreasing because the Fed has been so slow to act is what worries El-Erian the most, he said. In 2021, Federal Reserve Chair Jerome Powell claimed that inflation was temporary as monthly inflation rates continued to rise. He later agreed that the term should be abandoned. Since then, the Fed has increased interest rates twice in the past 2 months, each time by 75 basis points. The major inflationary forces have been the cost of energy and food. From their high earlier this year, oil prices have significantly decreased. For the first time since Russia's invasion of Ukraine this past summer, West Texas Intermediate futures prices this week dropped under $90 a barrel. Reduced oil costs should reduce inflation. In particular, energy and food will be significantly weaker drivers of inflation, thus the headline number will decrease, according to El-Erian. And to make matters worse, the core number will continue to rise inexorably. And that simply illustrates how deeply ingrained and widely spread inflation has grown in our economy. According to Mohamed El-Erian, if the Federal Reserve's monetary policies fail to contain surging inflation, it runs the risk of damaging its own reputation. The eminent economist expressed concern that the U.S. central bank's lackadaisical response to soaring inflation could result in collateral damage to its own reputation. El-Erian told Yahoo Finance, "What I'm most concerned about is the collateral damage that's going to be linked with inflation coming down because the Fed has been so slow to respond." The warning from El-Erian comes as inflation is at a 41-year high of 9.1%. In an effort to control prices, the Fed raised interest rates by 75 basis points in both June and July. However, since then, Chair Jerome Powell has said that officials will base their decisions on facts. El-Erian, a former chief executive of PIMCO, argued that the Fed should maintain its hawkish approach in order to restore its reputation after low interest rates, and a supportive monetary policy contributed to the 2021 stock market bubble. He declared, "We must tame the beast of inflation." In addition to tightening its monetary policies, the Fed must take action to establish credibility. Right now, its forward guidance is essentially useless, which is not a good thing. Some are speculating about the possibility that the Fed would opt to abandon its hawkish approach on tightening monetary policy in light of the economy's downturn and indications that inflation may be peaking. However, Friday's unexpectedly positive U.S. jobs report may influence the Fed's decision to continue raising interest rates. By the end of this year, El-Erian predicts that rising interest rates would cause inflation to decline. But he also predicts that the U.S. Consumer Price Index will continue to rise over the Fed's 2% target. PCI's July update is due on Wednesday. El-Erian pointed out that while central banks are tightening policy, the global economy is slowing down quickly, which should have the desired impact on inflation. For the upcoming 3 to 4 months at least, I believe U.S. inflation has peaked. We must determine how adhesive some components are. Last month, El-Erian spoke with CNBC. However, the fact that inflation will decline is not a concern. In fact, it is a really positive development. The issue is that inflation will likely decline as growth likely enters a recession, and that's not good news. The carefully watched commentator's views have changed as a result of the statements, as he previously stated that there was more opportunity for high prices to develop. He correctly anticipated at the time that inflation would surpass 8.5% in May and then pick up speed, noting sharp increases in energy prices and broader pressures. In reality, the Consumer Price Index increased by 8.6% in May before rising to 9.1% in June. He did, however, caution that inflation will probably not peak as soon as July. He stated last month that it is far too early to claim inflation has peaked. Gas prices have been slowly down for more than a month since he made his prediction in early June, indicating inflation may soon follow suit. El-Erian warned that the Federal Reserve must enhance its analysis, projections, policy responses, and communication in order to avoid making additional policy errors in a second column on Friday. The quick and simple reading of inflation data has proven to be inaccurate during the past 18 months or so. Will things change in the future? Markets certainly hope so. It makes sense that Federal Reserve officials would appear more circumspect. The most potent central bank in the world should not follow the market's most recent narrative flip. The Fed, the majority of market players, and analysts found immediate justifications to ignore the inflation danger when it first reared its ugly head early last year. The factors were exogenous, few in number, and historically predisposed to reverse fast. It was quick and simple to choose the transitory classification, especially since it did not call for a change in strategy. You merely see through transient things after all. Markets moved away from the transitory perspective as inflation remained and picked up speed, but the Fed stuck with it until the end of November. At that point, inflation's causes were becoming more diverse, and it had begun to permeate the economic system more thoroughly. Both policymakers and many market analysts and participants initially opted for a soft landing outcome. That is, the ability to reduce inflation without significantly harming growth, as a result of the Fed finally raising interest rates and laying out a path for quantitative tightening. Through balance sheet contraction, once more, it was quick and simple, and once more, it turned out to be too simplistic and biased. As the awareness spread that the Fed's need to raise interest rates quickly and aggressively in order to catch up with inflation would likely considerably harm economic activity, markets soon began to price in a significant chance of recession. Bonds and stocks both experienced a steep decline, and the yield curve began to invert. It was time for the Fed's soothing statements about a soft landing to be replaced with a more sobering tone and a more resolute policy narrative that included an unconditional commitment to fighting inflation. The spread between 2-year and 10-year treasuries decreased to almost minus 50 basis points at one point as the yield curve inversion grew more severe. The Fed made it clear that, in light of its string of gaffes, it would avoid providing forward guidance. The market's prevailing narrative has just been reset as a result of the recent combination of a stronger-than-expected jobs report and better-than-expected inflation statistics. This was done quickly and simply. The belief that the Fed will be able to finish its tightening cycle in the coming months and even start easing as early as next year will allow the impact on growth, employment, and earnings to be kept to a minimum. This places the Fed in a challenging situation. Does it emulate the market's easing of financial conditions, validating it with words and deeds, or does it stand firm and run the risk of upsetting markets that have restored stability following a disastrous first half of 2022? The Fed should refrain from taking yet another step that runs the risk of prolonging the inflation threat, no matter how alluring it may be to once again choose for the simple solution. This would further harm development prospects, further erode purchasing power, and place an even greater burden on the most disadvantaged groups in our society. The Fed must continue on its current track and exert every effort to seal the inflation genie once again. This is difficult and not without risk. However, it outperforms the other policy option open to a Fed that, as a result of its prior errors, no longer has access to a first-best policy approach. With that, we've come to an end. See you next time. Goodbye.